Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about mortgage rates, pending home sales, and insurance costs. Logan, welcome back to the podcast.
It is wonderful to be here, and I'm going to have to address something because people are asking me if I got a haircut. No, I have a hair clip because for the person that asked, this is what the hair looks like without a clip. So it's just a little bit too wild, and sometimes it's just easier to put a clip in. And I got my Scarface look.
You know, you're the only podcast guest I have where we talk about your hair. Just saying, you're the only one. It's a very singular look. That's why.
It's been a part of my life since the Peloponnesian Wars there. And by the way, I put that chart in Slack because, you keep on telling me, why do you use the Peloponnesian? I got 10-year bond yields, mortgage rates, whatever, going all the way back to 3000 BC. So
it was pretty funny. It was a good chart. So that was good. Okay, well, let's talk. We obviously were on yesterday, right? But we talked before the Powell situation. So let's talk about where you expect, how many Fed rate cuts should we even expect this year, 2025?
So it looks like if everything stays as is, 2 rate cuts are in. But when we move back a week before the Fed meeting and Waller kind of talked about, hey, listen, we might get more rate cuts. I think a few things were discussed in that presser that Powell had. Number one, the Fed really believes in the disinflation from rents. And he talked about it. We brought that up, the BLS new rent index literally collapsed. It's really rare to see deflation in rents in general terms, but that was a noticeable one. And then the core logic, single family, which is single families rents hold up better than apartments, and that was at a 14-year low. So to me, they hinted that out as, listen, we're not going to be raising rates because of inflation or anything like that. If everything goes as is, you got 2 rate cuts for sure in 2025. And then again, the bond market always revolves around economic data, but sometimes it can get overbought or oversold. But I thought that was a little bit more clear when they talked about the disinflation from rents. Then it goes into the bigger picture, jobs, right? Quote unquote, labor market solid. In that article that we wrote was, they're really hiding behind that now because the inflation data came out today. The PCE, personal consumption expenditure, that's what the Fed tracks. And we always go back to 2022. In 2022, they said, we would like the Fed funds rate to match 3, 6, 12-month PCE. If that's the case, then the Fed cuts a lot more. You get at least 1.5% of rate cuts into the mix. But they kind of switched the game plan up and said, the labor market's going to really run the show. And they keep on saying, well, wages don't really create inflation. And you're attacking the labor. You literally have thousands of statements saying wage growth is too strong. So they kept with the labor theme, saying that we saw some labor weakness. Those revisions, scare them a bit. Again, the private payroll sector slowing down, and this is where Powell actually kind of really admitted it. The hires, he said, if you have a job, it's great, but the hires have slowed down enough. So it was finally kind of an admission that, okay, the labor market's getting softer, but we're just going to keep financial conditions as tight as possible until they break. And that was the key phrase that I used in 2022. And here we are. Conviction in the statements is, yeah, well, if you're looking for a job, it's a little bit more difficult, but if you have a job, that's great. That is basically jobless claims. And today, jobless claims came out, went down again. 4-week moving average is around 211,000. So they're kind of hiding still behind that labor market data and just trying to get to where they think neutral policy is as slow as possible without breaking the labor market. And I think it was clear about that. I think that the initial Fed statement itself confused people because they said, our goal of 2% is not there, but he kind of walked that back when he had the Q&A.
Okay, but even if they cut rates, would it mean anything to mortgage rates if they cut their Fed funds rate?
It is always a positive that the Fed is telling the marketplace they're going to cut more. Now, again, if the Fed really wanted to lower mortgage rates, they would stop quantitative tighten. They would cut rates more aggressively. They would let the market know that as well. That's not the policy, right? And we always go back to Neil Kashkari's statement, which I still think is, maybe the Fed's baseline statement. They can't say it publicly because, when he said it, everyone latches on him. Can you balance the economy with just mortgage rates at 6%? Yes, you can. It's not gonna change any of the inflation data, but I think again the fear of housing, right? The fear of people buying homes, having sex, having kids, needing more stuff, population, stuff like that. That's inflationary. And he even said, housing stabilized. Well, everyone was making fun of that statement, but technically the housing market did stabilize after November 9th, 2020, only because it had the fastest crash ever. And if you look at the existing home sales market, we're just basically stuck here. But then later on said, well, mortgage rates went up, and I feel like, in a sense, that's going to hit housing, and we saw that in the pending home sales data that came out today. But we saw that in the weekly tracker the last few weeks that the growth rate has really slowed down to the point that we've had a few negative year-over-year prints, and that kind of looks out a little bit later on in the existing home sales data. So the tracker is there just for something like that. We try to find that rate variable with existing home sales, and God, it's just getting towards 6%. Sales can grow,
Huge
people
difference.
can move, but labor over inflation, and that's I think that Fed meeting was really more about that. We're holding everything until if the labor market does get weaker, we'll make some changes, and the bond market will get ahead of them, of course. But jobless claims runs them all, and we're going to have a big jobs week coming up next week.
So I interviewed Bob Brooksmith of the NBA that went live today when we're filming this, and he talked about the fact that what they were calling on President Trump to do, or his administration, is like the mortgage insurance premium. That changing the MIP could immediately change. That's a way to change affordability, to change a rate without something they could do really fast for certain borrowers. What do you think about that?
I'm just legally, I remember the FHA 2012 Solvency Act. So I don't know how much they can do with that. So this is again not my wheelhouse. That was my first thought. Would that actually be okay with Congress? Do they have enough reserves? I think Freddie and Fannie were leverage ratios were like 1-72 to 1-75 before they got into trouble. This is also why they should never be, back in publicly traded companies ever. But FHA was like 1-33, so they had a high leverage ratio, and then they created that Solvency Act to make sure that lending is functional. That would help kind of the lower end spectrum, a first time home buyer, because it's a low down payment loan. The velocity in that I question. I think if mortgage rates, I mean, the builders basically have shown you, like, if you can get sub 6% mortgage rates, you're growing sales. I mean, they're at 2019 sale levels. That would equate to near 5 million existing home sales. That's how you get near 6 million total home sales, like we did in the last decade toward the peak. So anything to lower the cost of housing, that has a positive variable. I question the size of it, just because FHA after the financial crisis was an unbelievably high percentage of loans, just because there was no down payment. There was no low down payment loans after 2008 until Freddie and Fannie came with their 5% down, and then FHA moved down on the percentage sale. So a positive, but velocity maybe not as big as some people would think.
Let's talk about pending home sales, right? We talked about the tracker a little bit earlier. You're watching all of these variables every Saturday. You write up because we get that fresh weekly data, like you like to say, from Altos Research. What did we see this week with pending home sales?
So when we saw what happened last year, starting in summer, the pending contracts started to act much better. Mortgage rates started to go lower. Shockingly enough, forward-looking demand got better. But then toward the end of the year, it really got noticeably better versus 2022 and 2023 data. So firmer bottom every year that goes on, more people are working, dual household incomes, wages increase. But you've had like 4 months of positive data, so you're not using that low bar anymore, right? So when you get to a higher bar, and rates go up, it's harder to keep that growth going. That's what happened in 2023. That's what happened in 2024. And here we are again. Mortgage rates are at 7%. The growth rate of inflation has two handles on all 3, 6, and here we are again. Jerome Powell kind of hinted at that. Yeah, mortgage rates went up, and it's going to impact housing. So we saw the positive growth rates slow down in the pending contracts, and then the last 2 weeks were negative. Nothing big or spectacular in any fashion. In fact, it's still higher than 2023. But if you're looking for growth from a very, very low bar, that's kind of what you not want to see. But then the higher rate variable kicks in. And then when we think about what happened in 2024, mortgage rates did not get down towards 6%. They got down to like 6.63 early in the year, and then rates headed up towards 7.5. The spreads are really, really preventing rates from getting above 7.25, right? And that's part of the model, is that the spreads get the average trend basis points is 27 to 41 basis points better, and then this is part of the reasons why I had the 7.25 peak. In 2023, that didn't work as well because the spreads got worse. They got cycle high levels, but here, not the case. So it's a tug of war. It's just such a mud fight between two guys. Rates go lower, demand picks up, rates go higher, and you're just kind of stuck in this level. And then there's the new home sales market, which sits there. Their purchase application data is still showing year-over-year growth because they could live in a sub 6%. So we have levels that we know we can grow sales, but we have policy that is not designed for housing. Policy for the economy. We had GDP today came in lower than estimates. People got a heads up on it. A lot of that is inventory, but the domestic sales that the Fed tracks, above 3% again, 3 straight quarters of consumption being fine. Policy is not restrictive to go into a recession, but policy is restricted enough to keep the existing home sales market in a recession. Since June 16th, 2022, 5:31 p.m. Sarah Willa, that was the call back then.
That was when you called it. Yeah. I mean, just being at the IMB conference, more upbeat for sure than we've seen in years past, but just a realization from the stage and from people in it that this year's probably not going to be a blockbuster year. It's not going to be 2023, but it's going to look a lot like 2024 as far as we're sort of stuck.
Here's the thing. When I say the worst in housing is over, I go to these cities and talk, and we just got back from Illinois. We're going to Ohio, Columbus, Ohio. Oh, I'm so excited. Yes. And when we think about housing economics, affordability, the prices rising as fast as they did was terrible, right? The irony is, Sarah, as soon as we got past the summer of 2020, I went into my, this is not good, right? It's funny because back then people would say it's a very hot housing market. This is unhealthy. Oh, we need higher mortgage rates early 2021. Oh, this is really, really not healthy. Oh, this is savagely unhealthy. So that was when sales were up and prices were escalating. Here, I'm like happy face. Like people always say, why are you so happy with the housing market? Because we're getting balance. And people don't realize this, with the price growth slowing down and inventory rising, household formations, wages grow, we're in a more healthier housing market. Because the worst part was prices escalate out of control, because that impacts future demand, like we've seen here, right? We're record low levels, 4th calendar year now. But now even more, if rates just get to 6%, we're growing sales, right? Well, for some reason we get below 5.75, my forecast, oh, we're really growing sales. And every year it goes by, that construct of housing, right? All these homeowners are doing really good, household formation, all these things, the firmer bottom gets in place. And, in a sense, that housing becomes more affordable in that sense, with wages growing, price growth slowing down. And then when eventually rates come in, then you have all those people that were just waiting. And then all those new people coming in, because we're still going to have another year of 5 million total home sales. It just gets better in that. If home prices were running at 8 to 10% again, and you don't gain an advantage, that's a negative. But here is a positive. Last year, forecast was real home prices to be negative. Case-Shiller, another all-time high. Here, another negative real home prices to me is a positive. And I go back to 2019 when I went on a conference and had real home prices are negative. Great news. Everybody looks at me. Oh, it is. Trust me. So I'm happy about this, because I know eventually when policy becomes a little bit more dovish for housing, that firm bottom is still there. And now comes more and more people, and you could really grow sales from these really low levels. That isn't a problem, but we've only seen it with rates at 6%, heading towards 6%, and then under 5.75. The builders are showing you, hey, you want an extra 500 to a million home sales. There's your ticket right there.
So the variable that we're looking at now, that we have been looking at over the last, say, 18 months, but I think is more part of that affordability conversation, is the insurance, right? What does the insurance conversation do to home prices over some period of time? Does that moderate? Because it's like, listen, I can't afford this house, so now I'm looking at this range. This is what I can afford on that monthly payment.
I go back to my Yahoo interview early 2024. There are some parts of the U.S. that some home buyers are not going to live in, and that is a net negative demand about a situation that has not been solved, right? If you cannot get insurance, you can't get a mortgage, right? If you're in an area that gets constantly, hurricanes or fires, do you want to live in that? So the insurance problem is a little bit more bigger than just the cost. It's the quality of life. And in areas, we've seen areas where people just don't go back and live there, right? So the bigger problem this gets, the more people get into the pool of, hey, listen, I'm not living here anymore. I'm taking my family. This is why when I go to Ohio, I say, you guys have the state now, right? It's cold up in the Midwest or parts of the Northeast, but you don't have fires or hurricanes or FEMA saying they're not going to fund you anymore. So it's people just remember housing is the cost of shelter, and you just want to buy a home and live in it and raise your families. That's what it is. And when you have that insurance issue, it just becomes a problem. Now, of course, it's worse for condos than it is. But I'm hoping again that the federal government, state, and the private sector find a solution. And the faster they find a solution, the better it is for everyone, because then everybody can start planning. But if you're like in limbo land, every year that goes by, you get closer to death, Sarah Wheeler. So you need to basically figure out where you're going to live and raise your family and do. So I think the faster you get some kind of resolution, the better it is for everyone.
I'm gonna embroider that on a pillow, put it on my couch. Every year you're getting closer to death, because this is just the reality, right? But I do think that the uncertainty is difficult. It's one of the things we're going to tackle on February 26th at our Housing Economic Summit. We have some specific insurance experts coming in to really lay out, like, what are the implications, and when will we know what the implications are? And not just for, if you live in California, but how those are split, how that risk, how that cost is going to be borne by everybody throughout the United States.
You know what's interesting? That conference is ridiculous now. There's way too many talented people in one day. Like, I am trying to figure out, like, when in history did I ever remember seeing all that housing and economic talent in one day? Usually you get 2 to 3 speakers that talk about at most, and we have a ton out there. So that'll be so interesting because it's so many different people with so many different views. And people could absorb the data and see what's going on. And plus, it's by February 26th, the tracker we have a lot more data to go by out there. And I still believe I'm going to be right this year. Okay, we're going to get new listings over 80,000. I was off by 5,000 last year. Inventory is going to grow. Right, the higher rates inventory growth model that's worked since 2022 with our data line, and we'll take it from there at that time, getting ready for spring. But yeah, the insurance, property taxes, everything, the cost of shelter. And again, when you live in your house for such a long period and your wages grow and you have a low total housing cost. I know a lot of people like to focus on the rate, but just think about the low total housing cost that a lot of people have. And then all of a sudden, I always say this every conference, every day, the best hedge against inflation on planet Earth. Yep. There's a reason why they all hate us, Sarah. There is a reason. It's not because the chart daddy's hair is like this crazy, right? It's not this. It's because we have a fixed debt cost. Our wages rise. We have a 30-year fix, and then the quality of life is better. So in an inflationary period with higher rates, everything, Americans are shielded. Captain America shield, right? And they could take on some of the hits that you see on insurance. And I try to explain it to one gentleman a few weeks ago. Imagine your insurance costing you $1,200 a year, so you get a 100% increase. Right now, it's $2,400, and that's a lot, right? That's an additional $100. But
Logan, we're not talking those kind of things. We're not talking. My insurance for my little house is $1,200. I'm sorry. Were you talking about insurance or property taxes?
We're talking about insurance.
Okay, we're talking about insurance. True, but what we're seeing is that insurance companies just saying we're not going to insure you anymore,
that's a whole different problem. That's like that goes into you can't live in. But people are surprised about why aren't we getting the massive sellers? Because of insurance. And I'm like, homie, listen, it's an extra $100. Do you go to DoorDash? I'm a 24/7 DoorDash person. Okay, so if I had a choice between living in a house and ordering 2 less DoorDashes, I'm ordering 2 less DoorDashes.
Yeah.
But then the cash flow of homeowners are already good, so they could absorb that cost. So I'm trying to explain, like, why didn't we see a massive amount of new listings in Florida or Texas? Why is there's like a mass rush of people leaving, because they can't afford? They can afford the house. They could take on there are some people that are stressed financially, but on a national basis, we haven't seen. And again, I always repeat this: new listings data in 2008 to 12, kind of that period, was running at 250 to 400,000 per week. These people did not want to sell their homes, but they had to, right? And we are literally still not even back to normal yet, right? And I think we can get to normal in 2020, but that's if there was major stress in households, they would literally, there's $38 trillion of nested equity. Sarah, $38 trillion. Sellers could sell, right? They can sell, they can cut prices, they can do whatever they need to, because there's hardly any underwater homes out there. But they love their homes and they're able to manage the cost, right? And I think that's been the confusion, because you see these headlines about everyone's showing me this. It's going to be worse than 2008 home insurance. There's, I don't know, it looks like a ultimate doom porn, like Dr. Doom is coming to destroy the world and it's 2008 housing because of insurance. I was like, let's just run the math here. And then when you run the math, it's like, oh, it's manageable, right? It's not manageable if you keep on increasing like 100% every, there's parts of the US where it's much worse. There's parts of the US that can't get insurance. But if you want to know why you haven't seen a massive amount of new listings data, because nobody could afford insurance, still, realistically, when you take the total wages, remember, total wages, dual household incomes, right? Things can be done to absorb costs. And a lot of that is the low mortgage rates that a lot of people do have was that cushion, right? Every year that goes on, your wages grow. Then you had refinances, 2012, 2016, 2020, 2021, people living in their homes 11, 13, 15, 18 years, right? That was the shield. You look at housing in that light, and maybe that could explain why we haven't seen a mass amount of people rushing to sell their homes because they can't afford it. That's not the case.
That is good information. Logan, we are almost out of time. Thank you so much for being on. Looking forward to seeing you in person on the 26th of February at that economic summit. And before that, I know you have some stops at Columbus, Boise, a couple of places.
Columbus, Ohio, Boise, and then the next big thing in Denver. Oh, we got a lot left in the Chart Daddy Nerd Tour before we go to the big one in Dallas.
All right. Well, thank you so much for being on. Appreciate you.